Okay, hi there, welcome to a macro revision video. Now what I've done is I've put together 6 multiple choice questions, all from past papers, actually quite recent ones, on the economics of exchange rates. So this is a great chance for you to test your understanding and check your understanding of the economics of currencies. For each question, after I've read the question out, press the pause button, have a go, and then we'll walk through the correct answer and the explanation afterwards. So here we go. Here are 6 questions on the economics of exchange rates. Question 1. The country currently operates a free floating exchange rate. Why might a government change to a fixed exchange rate? The correct answer is either A, B, C or D. Please press the pause button and have a go at this question. Okay, the choice of exchange rate system is really key for governments as part of their macroeconomic policies. The question is saying, why might a government move from a free floating exchange rate, where the exchange rate is determined purely by the market, to a fixed exchange rate? And the correct answer is C, to raise the level of certainty for businesses. Actually, if A is wrong, if you have a fixed exchange rate, you need foreign currency reserves to be able to control the exchange rate. C is the right answer. A fixed exchange rate, in theory, is more stable than a free floating one. Makes it more predictable for businesses. For example, exporters will have a greater degree of certainty over the prices at which they export their goods and services, and likewise importers will also have more certainty. And a good example of this is the Danish kroner, which essentially is fixed against the euro. So Denmark's inside the European Union, inside the single market, but it has its own currency, the kroner, which is fixed against the euro. Obviously it moves a little bit from day to day, but as you can see, it moves in a very, very small range. This data is basically the last year for the exchange rate. Question number 2. In which exchange rate or currency regime would the central bank of a country be best able to follow or pursue an independent monetary policy to control the rate of inflation? Again, 4 options there. Please press the pause button, have a think about your answer, and we'll go through the answer in a second or two. So which currency system would the central bank be best placed to pursue an independent monetary policy to set their own interest rates, of course, to try to control inflationary pressure? And the answer here is a free floating exchange rate system. This is, of course, the case for the UK. Bank of England, made independent in 1997, has an inflation target of 2%, plus or minus 1%. And of course, they can set base interest rates in terms of trying to control inflation without necessarily having to have a very clear exchange rate target as part of their policy. Okay, question 3 is coming up. Which one of the following is most likely to happen to a country's currency value as a result of capital flight, assuming it is operating with a floating exchange rate system? Have a go, please, at question number 3. So capital flight is when you get often quite sudden and significant outflows, movements out of a country of hot money and portfolio capital. So investors, essentially foreign investors, seek to take their money out of a country and move it perhaps to a safer haven investment. Well, if that's the case, there'll be clearly a fall in the currency. So it's got to be either B or D. But we're also told in the question that the country is operating with a floating exchange rate system, in which case the answer must be depreciation. Devaluation is associated with a fixed exchange rate system. So the answer to question 3 is B. We're halfway through. How are we doing? Here's question 4. Now this is a calculation question. Again, it's from a 2020 paper, so have a go at this one. Country W conducts half of its trade with country X, 30% of its trade with country Y, and 20% of its trade with country Z. And the initial value of their trade-weighted exchange rate is 100. We're then told that country W's currency appreciates 10% against the currency of country X. It falls 10% against the currency of country Y, and it's unchanged against the currency of country Z. And the question is, what will be the new trade-weighted exchange rate, given it was 100 before? what will be the new trade weighted exchange rate? This is a calculation question, so please do press that pause button and do the maths. I'll take you through it in a second. Have a go, please, at question number 4. So the correct answer here is B, 102. This is a calculation question, and similar to calculating a consumer price index, you see half of the trade is with country X, so we'll give that a weighting of, let's say, 5. 30% of trade is with country Y, let's give that a weighting of 3. And 20%, the remaining 20% is with country Z, we'll give that a weighting of 2. Then you have to calculate the index for each currency. Well, we're told that there's been a 10% depreciation against X, so it'll be 5 times 110. 10% depreciation against currency Y, so that'll be 3, the weight, times 90, 10% fall. And 2 times 100, because 20% of trade is with country Z, but that exchange rate hasn't changed, so the index of the exchange rate has stayed at 100. If you add those three together, 550 plus 270 plus 200, you get to 1020, if my maths is right. And you divide by the sum of the weights, which is 10, and you get 102. So the answer is B. I've got 2 more questions for you. Hopefully these will be quite interesting ones. Again, recent past paper questions to test and check your understanding. Now this is quite an interesting one. An economy imports most of the factors of production used in the manufacture of its exported goods. What effect would depreciation of this economy's rate of exchange or currency have? So a country is importing most of the inputs used in making its exported goods. What effect would depreciation of this country's economy, this economy's exchange rate, have on 2 prices, the prices of imported goods and the price of exported goods in the domestic currency? Tricky question. Again, take a moment, give yourself some time, have a go please at question 5. So what do you think for question 5? Well, if the exchange rate goes down, import prices go up. So it'll have to be C or D. Don't forget, spiced, strong pound imports cheaper, while weak pound imports more expensive. So it's got to be C or D. And the answer actually turns out to be D, because those higher import prices, of course, are used in the manufacture of the exported goods. That's going to lead to an increase in the variable costs of producing other goods and services, including exports. And it says the price of exports in the domestic currency. That will go up. So the answer there will be D. And we have one last question in this little cluster for you. I like this question. The country has a trade deficit. It devalues its currency. Which combination of those shown, A, B, C or D, leads to a reduction in its trade deficit in the long run? Which of these combinations? They've got a table there showing 2 columns of elasticities of demand for exports and imports. Which combination leads to a reduction in its trade deficit in the long run? Take a moment, press the pause button for our final question, and then just press play when you want to go through the answer. Well, this question is about the Marshall-Lerner condition, which says that initially a trade deficit may get worse following a depreciation, particularly if the price elasticity of demand for exports and imports is very low, indeed, less than 1. Whereas a trade balance will improve if the sum of the elasticities of demand for imports and exports are greater than 1. So the answer here will be C, the Marshall-Lerner condition. You may well have come across this in revision for your assignments and assessments. Devaluation of a currency improves the trade balance if the sum of the price elasticity of demand for exports and imports, summing those 2 together, is greater than 1. Well, C, 0.5 plus 0.7, let's say, and 0.8 will add up to 1. So it has to be answer C. In all the other situations, the trade balance will either stay the same or, well, actually it would worsen because it's less than 1. There we go. 6 questions on exchange rates. I hope you did well on them. I think they're a good test of your understanding of this key topic. Thanks for joining in on this one. Really appreciate it. Stay safe, stay curious, and see you soon. See you all sometime soon.